Well, we are continuing to follow the latest on Dubai World's debt problems. Joining us now is the global head of currency strategy for Brown Brothers Harriman, Marc Chandler. Marc, great to have you.
Great. Thanks for thinking of us.
So we first heard about Dubai World's debt crunch last Wednesday. Well, today markets in Dubai and Abu Dhabi were tanking after the Dubai government said it is not guaranteeing the debt. So now we're learning that the UAE central bank plan will loosen lending by providing a liquidity facility. So what needs to happen, or is the situation stabilized now? Give us the latest.
Well, I don't know. I mean, here's how I think of it. One is Dubai has been on holiday like many of the Islamic world. It's an important holiday, not related to our U.S. Thanksgiving, but corresponding to that same period. And it's very much, to me, very similar to when the FDIC closes down banks. They typically do it on a Friday evening after the markets close, so that apparently, so a couple of days people can think about it and not react rashly. Seems to me the same thing that Dubai World did and Dubai did last week. It does seem that the markets are a bit more stable today. Still very nervous. Not so much about the particulars about Dubai. It looks like the Dubai and the related to the Abu Dhabi, the whole UAE situation seems to be self-contained more or less. I think what the market's concerned about is, will this be the approximate cause, if you will, to prompt some what many people suspect is long overdue profit-taking in the risk assets themselves, equity markets, emerging markets, commodities. Is this going to be the trigger that gives us this profit-taking before the end of the year? And so far, I'd say the jury is still out. The market's leaning that way, but nothing convincingly has been done today.
What's the timeline for a catalyst to figure out if this is going to be the profit-taking you're referring to?
Well, I think it's a combination of getting by. You know, this week is very important. Leaving aside Dubai, you've got the Reserve Bank of Australia meets. They have not hiked rates 3 times in a row ever, and they might do so as early as tomorrow. The ECB meets this week, and they're going to give us more details about their exit strategy. And, of course, the highlight of the week for the U.S. economic data will be Friday's non-farm payrolls report. So I think we need to get these events out of the way before we get a clearer picture.
But wouldn't this situation encourage central banks, with the exception, obviously, as you just described, Australia and Norway, to delay raising interest rates further?
Well, I think that, you know, if everything else is equal, and this pressures some banks marginally, again, the exposure to European banks is something on the magnitude of $80 to $90 billion. While it's a lot more money than you or I might have at the moment, at the end of the day, given the kind of hit these banks have been taking on different derivatives, on real estate markets, this is just a modest, rather small hit, and unlikely to change policy. But if everything else was equal, you'd have to say this would make banks more cautious, central banks more cautious rather than more aggressive. But I'm not sure that really counts for the Reserve Bank of Australia. They're seeing some strong economic data, right, some price pressures. I don't think they're going to be reacting very much to what's happening in Dubai.
Marc, you recently wrote a very extensive piece about the debt crisis there. Give us a sense of the enormity of this. Could this destabilize global markets? And perhaps even parenthetically, with Americans concerned about their jobs here at home with that unemployment rate over 10%, give Americans a sense of why they should sit up and take notice. How does what's happening in Dubai matter to them?
Well, at the end of the day, I think it's probably just a marginal story. I think a couple of good points, though, that could be brought out is, one, what's happening in Dubai has nothing to do with the U.S. subprime real estate problem, nothing to do with the commercial real estate problem that is brewing in the U.S. or the collateralized loan obligations. This is a problem, and this is why we often argue that the financial crisis is not a U.S. phenomenon, but it's a global phenomenon. Various and numerous actors were responding to the same incentive structure, which was investor euphoria, cheap access to capital, and it led to overbuilding. I mean, you're talking about in Dubai, the tallest building in the world, the tallest freestanding hotel in the world. You know what they're talking about. You see some of these things that Dubai has built, indoor skiing in the middle of the desert. These things are excessive, and I think that this is what we have in common is that the U.S. it's not something wrong with Anglo-American capitalism or the U.S. This is a global phenomenon where people got overstretched, and Dubai, in a big picture of things, Dubai makes up roughly 2% of the UAE's GDP, which itself is a small fraction of the U.S. The size is not the issue. Yeah. The issue is whether this can act as a catalyst the way Thailand did in 97, 98, or perhaps the way Iceland did a couple years ago. I suspect that that's not going to be the case. I suspect that the key problem is the market is very long risk assets, and it's not clear yet. I mean, our equity team went neutral several weeks ago, thinking that we're stuck in a trading range after pricing in a lot of good news. And I think that the same thing generally for the dollar. We're stuck in a trading range roughly on the euro, 148, 151. To the extent we've seen a breakout in the currencies, it's the strength of the Japanese yen.
Lots to digest. Marc
Yes.
Chandler, thank you so much for your
Thank
time
you.
and your insight today.